Great. Well, it's a great honor to speak here again, do the keynote again. And before we start, I just thought we could do a round of applause for AltFi and all the great work they do in terms of covering our space. The title of my presentation is To Be or Not to Be a Bank. It's a question that is often asked to us now quite a lot, and one that I think, as David said, the industry is probably bifurcating along. Before we do that, I just thought I'd give a short overview of Funding Circle for those of you that don't know us. So, Funding Circle is the global leader in direct lending to small businesses. We've originated about £2.8 billion through our platform. We operate in 4 countries, so the UK, US, Germany, and the Netherlands, with aspirations to enter many more. And the lending through our platform has created, we believe, about 100,000 jobs globally. So that's independent research done on Funding Circle by CEBR, which just speaks to the big societal impact that these platforms can actually have in parts of the market. We've supported about 36,000 small businesses and generated over £130 million of net earnings to investors as well, so creating huge value on both sides. And again, that CEBR research found that £4.5 billion, so this 2.8 billion has generated about £4.8 billion of economic value or extra GDP. So again, huge impact. I showed a similar slide to this last year, but I think tough times in our industry have meant people have really started to question our model. So we've had a lot of different stuff going on, from comments by Lord Turner, although he subsequently moderated those, to Ponzi schemes in China, to issues at Lending Club, which I think are very well documented. I stood up here last year and said that actually, despite all this stuff that's happening, we were entering a golden age for our industry, and I still believe that. Certainly in our platform, we're seeing record levels of volume. We're really starting to see very exciting growth, and I think you are going to continue to see that over the next few years. And because of all this noise and this stuff that's happened in the market, the industry is really fragmenting. So we have our peers at Zopa announcing earlier that they're to launch a new bank. But you also have banks actually trying to launch platforms. So Goldman Sachs is an example, but also Royal Bank of Scotland recently also said they would be launching or have launched a small business lending platform. So the lines between platforms and banks, on the face of it, appear to be blurring. And we get asked this question a lot, and kind of fed up of answering it, but we'll keep answering it, is we at Funding Circle have no plans to become a bank. And I thought I'd just talk people through the rationale from our side. So the first set of reasons really why small business lending doesn't really make sense for banks anymore. And what you've seen is a massive reduction in the amount of lending that banks have done to the small business lending market in the UK. But I could draw this exact same graph in the US, Germany, Netherlands. It's pretty much the same. And there are a few reasons for that. So the first is that regulators have increased the capital requirements and regulation around small business loans. So Basel III recently massively increased the amount of capital banks have to hold, which makes it much less profitable to serve. Bank processes can be long, complex, and opaque. It takes a long time to get a small business loan. It can be 3 months, as much as 6 months in Germany. So it's a really bad process, especially when you put it alongside what people are used to in your personal lives. With Amazon being able to deliver a package to you within 2 hours, you kind of juxtapose that against this bank process, which is pretty antiquated. I think people, small businesses are choosing other ways of doing things now. And it costs banks the same to underwrite and process £50,000 loans as it does to do £3 million loans. So they use the same processes, procedures. They haven't really digitized a lot of the way they do things. And actually, to be honest, in small business lending, because it's a relatively small part of what bank balance sheets compared to mortgages, corporate lending, this is actually at the bottom of the pile in terms of what they're going to go and digitize. And part of the reason that capital requirements have increased so dramatically is during the financial crisis, when losses started to go up on subprime assets, I think we started to realize what a huge amount of what maturity transformation was happening effectively in the banking system. So what this shows is the liability and asset structure of a bank. And on the left-hand side, you'll see this is a major UK bank, effectively deposits. So you see that over 95% of the liabilities of this major bank are in sub-1 year loans, sub-1 year deposits. And then they take that money and lend it very long. So actually, if you look there, over 60% of the loans are actually for a duration over 5 years. What that means is if we all go to the bank tomorrow and try and get our money out, the bank doesn't exist. It just doesn't have the capacity to do so. And this really got exacerbated during the financial crisis, not just with banks, with these structured investment vehicles, all these different things that we found were very highly levered with very low amounts of capital. So it's right that regulators have dramatically increased the amount of capital that banks have to hold. You know, if we're all going to be on the hook for bailing these things out, we need to make sure that banks are much safer, that they're not going to go down. If you compare that to lending platforms, we perfectly match assets and liabilities. So it's a much more stable structure. There are sometimes secondary markets where you can access your money early, but the reality is people's money is locked in, they understand that, and if they can't sell the loans, they have to stay for the total duration. So it's a much more stable infrastructure, much more akin to, say, something like asset management, where capital requirements are lower, and they should be lower because there's no systemic risk. And because banks have had to increase dramatically the amount of capital they hold, that has dramatically reduced the profitability of banks and therefore the valuation. So what this shows is a common measure used to value banks. So I used to invest in banks in my past life a long time ago. And the multiple of the value of a bank to the equity on its balance sheet has dropped from around 2 times prior to the crisis to less than 1 times for the majority of banks. So put it another way, what the market is basically telling us is that if banks were to liquidate themselves, that would be a better outcome than the continuing business that they're on. They'd be better off returning the equity to shareholders. And obviously most banks can't really do that. You can't just decide, oh, we're just going to give up and not do this anymore. But there are some institutions, like people like GE, for instance, which actually have another very big business. So GE actually had one of the largest banks in the world pre-crisis, and they did make that decision. They actually said, look, this is not, because of the capital requirements, because of the regulation in this space, we're actually just going to liquidate our bank, one of the biggest banks in the world, return the money to shareholders, and do some other stuff. So, you know, banking as an industry is pretty challenged. And one of the big things I think people miss about why there is a big space for platforms is, you know, the success of this industry may come down to something as simple as small businesses and consumers want choice. They want something that isn't a bank. So what I've put up here is, you know, different adverts for different banks in the UK. And, you know, they all look the same. I mean, it's crazy. I mean, small business lending to a bank means a lady small business owner looking in the bottom right corner of a table. I think Lloyd's is slightly different, so they're going a bit out there. But these guys, they all look the same. They all feel the same to small businesses. And they talk in the same way as well. And people just want choice. In markets where, especially small business lending, where 85% of the lending is done by 4 or 5 banks, choice may be the simplest thing that will justify the success of this industry, that there's something other than a bank. And I thought I'd show some of our customers as well.
I've had my fingers burnt in the past from borrowing from banks?
We explored banks with not a huge amount of success.
One thing that's become very apparent to us is the banks weren't particularly helpful.
Talk to me like a customer, not as a beggar. And I'd had that experience with my bank.
Banks.
Funding Circle was very easy and clear and to understand the process.
Being able to get the money so quickly, almost quicker than we were ready for it actually.
Without the good people of the Funding Circle, it's very difficult.
So that was just a snapshot of some of our customers. And when they talk to us, a lot of the time they do talk about the frustrations of dealing with the bank, how it is an awful process. They don't treat them in the way that they expect to be treated, and they want something different. And that's a big reason to not be a bank, probably maybe even the biggest reason. So I just wanted to talk a little bit about, so we've talked a bit about why banks probably aren't the answer or aren't great. I want to talk a little bit about why platforms are so great. We talk a lot about hybrids and balance sheet lender and you sell loans and things. And I've said many times before, I think that kind of doesn't really get to the heart of what we're trying to do. What we're trying to do as platforms is be the most efficient intermediaries between investors that want to lend capital or savers and small businesses that want to get access to capital to grow and expand, or individuals as well. And the most efficient model and the most efficient way of doing that is not to hold any inventories, not to do any lending, because that's when you can really get really powerful network effects. Platforms have huge advantages over banks. We have much more efficient credit processes. We have platforms that people can apply for loans 24/7. 50% of loan applications at Funding Circle come outside of business hours. You can't apply for a loan at most banks outside business hours. You have to go into the branch, get an appointment. And we're very transparent in terms of fee structures. We don't have legacy IT systems, infrastructure. And that's why you've seen tremendous growth in the amount of money that's being lent through platforms to small businesses. And what I've tried to show here is that the industry is growing very, very quickly in this area. Despite all the issues that people may have perceived last year, there was still very, very strong growth in the UK in SME lending and at Funding Circle as well. If you stick to this no inventory model, which I think is the purest and most efficient way of attacking this capital allocation problem, effectively you then have no right to exist. The only reason that we exist is because we provide great value to both investors and small business customers. And you can see that in terms of what we're delivering. So platforms on average have net promoter scores, certainly some of the averages we've taken, in the 90% levels. This is on par with what you see at companies like Apple, Amazon. In contrast, banks are negative. Small businesses and consumers don't really like dealing with banks, but actually it's reflected in the fact that they just deliver them a really bad customer experience. And in terms of investors, the net returns that have been generated, certainly on our platform, relative to other asset classes, have been superior to that generated on other asset classes, with a lot lower levels of volatility. So we're providing small businesses with faster, better, cheaper loans, and we're providing investors with stable, attractive returns. And actually 94% of small businesses that borrow through us have told us that they would always come back to us first in the future versus going to the bank. So once they experience this way of borrowing, they pretty much never want to go back. And part of the reason why I think platforms can get really good at this stuff is through these very powerful network effects. So certainly when we started Funding Circle, we didn't expect this to really be the case. But what we found is, the more loans and data that we're able to do, the better our models and underwriting processes get, which means we can have higher acceptance rates, but also priced with much greater accuracy. That means we have lower marketing costs, which means we can spend more money on marketing and actually getting more loans, and then you get more loans. And particularly in small business lending, where actually what we've learned is it takes about 2 years in any market to really develop the data for that specific market to be able to really assess these loans accurately. And once you've done 2 years, or 2 to 3 years really, by the time someone else has done that 2 to 3 years, we've done another 3 years, and we've improved things. We've got these powerful network effects. So the business model is much more scalable and defensible than people appreciate. It's very hard to get into this space, especially relative to other markets. Now, the biggest benefit of this no inventory or platform model is that the return on equity, and ultimately, the return on equity is how much profit or money are you generating for your shareholders relative to the capital that's actually in the business. The return on equity for a platform at scale is much, much higher than you're going to see versus, say, banks. So the average return on equity for European banks is about 8%. If you compare a platform like a Rightmove, which is in a slightly different space, it's 2,410%. And we're starting to see these effects in our UK business. So our UK business was profitable in Q4 of last year. And actually, once you strip away a lot of the extra investment we're doing, and it was profitable despite the extra investment we're doing in the business, the return on capital is closer to this Rightmove type level than it is for a bank. And ultimately, all businesses are about return on equity. You've got to deliver that to your shareholders, and this is what underpins all valuations and the way of doing things. So, you can become a bank, or you can be a hybrid, or whatever that is, probably make a bit more absolute money, but at the end of the day, the return on capital is not going to be in this type of space. And that's why these businesses are much more data and technology businesses than they are finance businesses. So I just wanted to say a couple of caveats to this, to why it may well make sense to be a bank. And I can't profess to say much about consumer lending. We don't do any consumer lending. And there are experts like Zopa and RateSetter that do that much better than us. But I tried to postulate some of the reasons that people might become banks. In the consumer space, there's a lot more non-bank competition than you see in small business lending. So whilst some of these institutions have become banks, like Sainsbury's, Tesco's, things, these are primarily brands that aren't doing banking. They do that as an additional activity. So it's much more crowded. There may be an argument that becoming a bank allows you to stand out or drives down the cost of capital. There may well be regulatory reasons. So consumer lending is much more regulated than small business lending. And it may be product reasons. So if you want to launch a credit card, leasing, things like that, there may well be good I think you could still structure them as a platform, but there may well be good reasons that it's more beneficial to do those as a bank. So those are some of the reasons why consumer players may decide to do that. And also, there are, I don't want to say that all banks are bad. I think some banks are doing a very good job and also providing, much needed choice in the market where, if you do things slightly differently, if you can provide customers choice, that's got to be a good thing. So I just wanted to now talk a little bit about why I think, you can have standalone platforms and you can have standalone banks and how they work together. And I thought this was very interesting. So what this shows is the net lending to small businesses by the 22 banks that are covered by the Bank of England. So this is gross lending less the repayments that come back. And I wanted to highlight a quote from Lord Turner that he made in October where he said, direct lending could be a spare tire to the credit system, making credit crunches less likely. So what you've seen since the referendum is actually a dramatic contraction in the amount of lending that banks are doing to small businesses. It's gone from around £1 billion pre-referendum to close to £224 million net, and is actually trending at negative levels in Q1 so far. And then you see the amount of net lending done by Funding Circle, which increased quite dramatically since the referendum result. So platforms are able to step into the breach that's left when the banking system is failing customers. And this is a classic bank behavior. When times get tough or things get a bit difficult, they will contract dramatically and not necessarily support the real economy. So this is if ever there was a strong argument for there to be independent non-bank providers of credit to the real economy, it's this. And I also think there are ways that platforms can engage with banks that make sense. So we have referral arrangements with RBS and Santander where they refer loan customers they can't help to us. That's because the capital requirements are so high on small business loans for banks. Actually, it makes a lot of sense for them to. There are large groups of customers they just can't service because of the model. And in those types of relationships, I think it makes a lot of sense. Banks can also buy our loans. Again, there's been a lot of talk about cost of capital. Banks have a lower cost of capital through deposits, things like that. I think what's quite interesting is if you look at a platform like Lending Club in the US now, about 34% of the loans are purchased by banks, and they typically tend to stick to the lower risk parts of the market. So I kind of don't see a cost of capital advantage there if you've got banks buying loans at low rates. I can't really see where the advantage is there. And actually, we are increasingly getting more and more interest from banks because of the high cost to serve this part of the market. They can actually get involved in purchasing loans alongside other investors. And then I also think co-branded opportunities. So, I think some banks are starting to realize that actually platforms do a very good job of data analytics, really assessing credit risk in a unique way. And there are opportunities to co-brand and sit alongside banks. We've been pretty negative on white label arrangements. I think in an arrangement where you're a white label provider or technology provider to a big bank, I think there's only really one winner in that situation, and it's certainly not the platform. But I think co-branded relationships where platforms can actually expand their brand, are known for being good at certain things, I think can work very well. So I think we've come a long way in terms of our marketing in particular. In the early days, we used to put out adverts like this, saying no thanks banks, and saying banks are going to go extinct, and like this guy over here. But I think the reality is, there is a space for platforms alongside banks. There can be independent, large platforms, and there, to be honest, there will always be banks as well. So I think there's hopefully been a maturing on both sides of the debate. But what I would say is, and this is the classic Henry Ford quote, awareness of platforms like ours is still very low in the UK. So less than 10% of small business owners actually know who Funding Circle are and who other peer-to-peer lenders are. And that awareness is only going to increase over time. It's an interesting one to compare it to the motor car industry. I think we will have more and more motor cars, or cars, which are obviously platforms. And I'm sure there will still be people who want to ride around on horses and keep working with banks as well. So thanks for listening.